Afternoon, everyone. Praying everyone is having a blessed day today and a great afternoon. Again, my name is Richard Richardson, CEO and owner of Eternal Equity Investments, which is a financial services company. We deal with debt management, retirement planning, life insurance, and other avenues when it comes to finance. We just teach people how to save, grow, and make money. I'm also part of the Generational Wealth Builders of Alabama group. Proud to be a part of that group as well. Again, our whole philosophy is we're just trying to help people create generational wealth. So again, as we speak with our clients and, our clients have questions, they talk about different things, I just decided to share, my answers that I give to them, I want to share with you all as well. Because if they have questions, I'm assuming that those in the general public has questions as well. So last week we dealt with different types of life insurance policies. We talked about term, and then we talked about the two different cash value, permanent cash value life insurance policies, and whole life and index universal life policies, IULs for short. Well, today, 'cause one of the questions that I had from a client was, trying to get into detail, explain to them how the cash value works, how it grows, how it earns interest and things of that nature, and how you can grow your wealth that way. So what I'm going to do is I'm just going to dive in and actually teach you all how the IULs work, how the cash value is determined, where it comes from, how it's used and how it grows. So, real quick, just at a high level, you understand that when you get an IUL, cash value policy, with every policy, part of your premium that you pay goes to take care of the cost of insurance and administrative fees and stuff that the life insurance company is going to charge. So, for example, if you got $100,000, these are just hypothetical numbers, but say you got $100,000 life insurance policy that has $100,000 death benefit, your premium is $50 a month. Uh, so, a portion of that is going to go to cover the cost of insurance, the cost of having $100,000 death benefit. And then a portion of that is also going to cover the administrative fees and stuff for the life insurance company. So we're quickly just going to bring up a spreadsheet so you all can see the numbers as I'm typing it in. And so what happens is a portion of that then goes into a cash value account. So let's just say hypothetically that $40, say your premium is $50 for that policy, and $40 of which goes to cover the cost of insurance and administrative fees and stuff. So that means $10 a month, just put it in here, is going into a cash value account. And so at the end of the year, so 10 times 12, you have $120 into that cash value account. And then what happens is when you sign up for the policy, you select which indexing strategy you want to use to determine how much interest to credit to that account at the end of the period. Most of the times it's a year. And so at the end of that year, they're going to look at that index and say, just hypothetically, say it performed at 7%. It earned 7% for that year. So what happens is you've earned $8.40 on top of the 120 that you put in there. So now your cash value account stands at $128.40. Hopefully everybody's tracking. And so the next year, say you do the same thing, that you get the same premium, and then $10 of that premium is going into your cash value account. So now at the end of year two, you have $248 in that cash value account. And now, say at the end of that year, say that index again did, we just say 5% hypothetically. So you earn $12. And so now you can kind of see how it continues to grow. So let's say in year three, same premium and everything, just hypothetically, you had $380. Now let's say, what if the market tanked? We have COVID, we have a recession, the market just tanks. Or, we have so whatever happens, the market tanks and it dropped down negative 10%. Here's the great thing about these IULs. There's a guaranteed floor, meaning you're guaranteed at least 0%. And when you have it over a certain amount of time, a life insurance company, a lot of companies will offer you, well, will guarantee you 1 or 2% as well. And so, say the market tank, that index dropped 10%, there's a guaranteed floor. You lose no money. So you still have, if you see, you still have your $380 that you had in there at the end of year three. The market tank, and you didn't lose any money. So that's one of the great benefits of IULs and being able to grow your wealth because your money's not in the market. So technically, this is not an investment because you're not actually buying a product. You're not investing in a stock or a bond. You're not buying ownership in anything. This is just how IULs work, um, and so that's one of the great features of it. Now, here's the other second great feature of it. We'll delete these numbers here and we'll start back over. Hopefully, everyone got that. So what you're able to do with a life insurance policy, with a cash value life insurance policy like an IUL, you're able to what we call overfund it. So your cost of insurance for that policy is still $40. And you still have out of that $50 premium, you still have $10 that is going into a cash value account. Well, the IRS allows you to overfund it. So say, for example, you had an extra $150 a month in disposable income and you're deciding what to do with it and you say, okay, I got this cash value over here, I got this cash value account as life insurance policy, let me put it there. So now you add that 150 onto that $10. Now you're putting $160 a month into that cash value account. Now look at how the money grows. Go back to that 7% again. I hope you all are following me. And so you're able to do that with these policies. You're able to overfund it up to a certain amount. Is up to what they call that guideline level premium. Once you get that guideline level premium, if you go over that, it becomes a modified endowment contract, and now it's treated completely different. So again, say you got that $160 again, and we said 5% the first time. Look at how your money is growing. Um, and also, you're able to access that cash value at any time, and you can do anything with it. Now, I recommend doing loans. You get you get a loan out from that cash value. You do whatever you want to do with it, and then you're paying yourself back. So you're essentially acting as your own bank. So now, one of the things that you're going to hear people say is that it doesn't have the same market performance as something that's in the variable market, a stock or a mutual fund, or things of that nature. And that may be true, but with any type of a wealth creating vehicle, it all depends on where you're putting your money at. I mean, if you are not a savvy investor, then it's almost like going to Vegas. So that's one of the things with the variable market is you really got to be wise, or else you're really putting yourself at risk. If you're not dealing with a licensed financial advisor, you're really putting yourself at risk by just throwing your money out there and different type of investments without any proper guidance. So we're going to do the same thing, put in the same exact numbers for the IUL as we're going to do with the variable market. All right. And these are just hypothetical numbers, but they're going to be the same numbers for each vehicle. So we'll go down here to 7, 160, 5. You all, this is recorded, so go off and make sure my numbers are accurate, which I'm pretty sure they are. I'm an engineer by trade. I deal with numbers every day. So what they will say is that the with putting your money in the variable market is going to perform better. Now, if you look at this, if they perform identical with the same interest credit to those different accounts, because of the guaranteed floor of 0% in the IUL, it's going to perform better. So what I'm saying is that if you're putting your money in the variable market and an investment vehicle, it has to perform better to just meet the financial gains that you're going to get from the IUL. I hope everybody's tracking that. So we'll change this. Let's change this to 10%. So if you see this, the money in the variable market has actually performed better as far as average rate of return. However, the value in your IUL is actually higher. Does that make sense? I hope everybody's tracking that. So let's go, say it had a great year, did 12%. you're still less. So you're at what did 15? So you're at almost 1.5% times well almost significantly higher in your average rate of return in your variable market instrument. However, your total value that you earn is actually less. That's the benefit of having the guaranteed floor. Um, and so, just wanted to explain that. And again, how much extra you're able to put in, how much you're able to overfund it, just depends on the death benefit, your initial premium. However, any life insurance agent, when they're running your illustration, they're going to be able to tell you the range of how you're going to be able to fund your IUL. Again, that's one of the great components. Also, what a lot of people don't realize, another great component of this is, say something happens to you in year 5 and you have your beneficiary here. Well, the things are beneficiary, well, money that is given to beneficiaries out of a life insurance contract is not taxed. So they will get, say, just hypothetically, in year 5, they're going to get the entire $10,727. However, if your money is in the variable market, something happens to you, and you have your beneficiary, well, that's going to be considered earned income for them, and it's going to be taxed at whatever tax bracket that they fall in. So again, that's one of another great components of an IUL contract. It's less risk. It's not subject to market losses or market downturns. It is truly compound interest. And again, to me, I'm a risk adverse person, so that's one of the reasons why I use. Now, I'm not saying don't put your money in the variable market. I'm not saying not to do that, but I just want to make sure you are aware of your options. Now, one other thing I want to highlight here is when we talk about generational wealth, and here's the part where I say, here's how you create generational wealth. One of the things that you're going to be aware of, and actually, let me just go back to so you all can see me. One of the things that if you will study any wealthy person or you study a lot of wealthy people, one thing that is common amongst them all is they have multiple streams of income. And so, I get, asked by people, well, what should I do with the cash value when it grows to a certain amount? And I say, well, you can do whatever you want to do with it. But if you really want to create generational wealth, you have to identify ways to create multiple streams of income. So say hypothetically, for example, you paid into this policy, your policy has grown up to $100,000. That's the cash value that you have in your account. What essentially that means is you have an asset that is worth $100,000. And so what do you want to do with that? I can take it out and I can take a loan out on it, go blow it, go to Vegas or whatever. I can do whatever I want to do with it. But consider this. You have a $100,000 asset. Why not borrow from that $100,000 asset, take that money and go to another vehicle that's earning interest as well? That $100,000 asset is continuing to grow because you borrowed from it. You didn't withdraw, you borrowed from it. So that asset is still continuing to grow. You still have this $100,000 asset. So basically, you're using this as leverage. You're using the cash value in your life insurance policy as leverage to take out a loan. Take out that loan, use that loan money to now create another vehicle that's earning income for you. Now you got two avenues to where you're earning income. You have two multiple streams of income. It is similar to like taking out a home equity line of credit or you're taking out a home equity loan. You're borrowing against a asset that has value. And so you can treat the cash value in your life insurance policy the same way. So now you have multiple streams of income. So you have two vehicles. As long as you continue to pay your loan back, you have two vehicles that are earning interest for you. Hopefully. Well, we know the cash value in your life insurance policy is not going to go down, but hopefully you picked a solid vehicle over here as well that's earning interest for you. So say you got this vehicle earning 7%, your cash value is earning this over here. Now you're growing two. You have two streams of income. So those are just things that you may want to consider. And then, yeah, I would consider that, no matter what vehicle you're using, is to try to use an existing asset that has value, leverage against that, and use that to fund another stream that where you're creating value as well. So, again, that's our talk for today. Hopefully, you all got some valuable information out of it. Again, we deal with these every day. We just like to educate the general public. If you have any more questions about, life insurance policies in general, please don't hesitate to reach out to me. Again, my number is 256-509. 3136. Or you can reach us at go to our website, eternalequityinvestments.com. Really looking forward to hear from you because we believe life insurance is important. But again, to have these other components to a life insurance policy is just value added. It is a win-win proposition, and we try to encourage all of our clients to go that route. So again, hopefully you all again got something out of this video. And again, don't hesitate to reach out to me. God bless.